My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. All right, folks, welcome back. Today we got a special treat. We've got a very experienced real estate entrepreneur on the call. Arn Cenedella is zooming in from, is it South Carolina now? Is that correct, Arn? That's where you're living?
That's correct.
California, where he lived for many, many years. But here's what's really interesting that I'm so excited to talk with Arn about this. Arn spent a long time, a whole career in residential real estate sales. He was a hotshot real estate agent, realtor. I don't know if you're a broker as well, Arn, but in that whole residential space. And then at age 64, he pivoted into multifamily real estate investing and has done some amazing things in a very short period of time, built up a very significant portfolio of properties under management. He's raised a ton of money for different projects he's been involved in. And it's really an interesting pivot to make at that age. So Arn, thank you very much for being on the show. Look forward to chatting.
Yes, Dave, thanks for having me. And hopefully our chat will prove useful to your listeners on their real estate investing journey.
Well, I'm just fascinated by that whole switch because that's, it's real estate. Yeah, it's in the same realm, but that's a major pivot, my friend, going from being I would think anyhow, from being a realtor, especially with single family homes, residential, to becoming a general partner, a syndicator, all those kind of good things. So maybe walk us through how that came to be.
Yeah, sure. Great question. So I got into the real estate business 1978 after I got out of grad school, and I have a master's degree from Michigan in physical chemistry of all things, never did anything with it. Returned to the San Francisco Peninsula where I grew up. My dad had a residential brokerage business. So 1978, I became an agent. By 1980, I was a broker. And he was a single family investor, kind of a very old school type guy, born 1921. So he actually lived through the Depression. And that, the time period you come of age shapes everyone's perspective and kind of philosophy about life, about investing. So I started investing in single family homes. Back then, you could actually do that in the Bay Area. Of course, now that they're 2 million, it's a little hard to buy a $2 million rental house.
Yeah, hard to make that one cash flow.
Yes. And was fortunate to start investing in Austin, Texas back about 2000. And of course, we all know what happened in Austin, Texas.
Again, in single family homes in Austin?
Yes, single family homes. And that's kind of what I did. And single family homes are great. Buying rental properties in good markets, it's kind of a tried and true strategy proven over the decades to create wealth. Can't say anything wrong with it. That's what I did, and it worked great for me. And then about 10 years ago, decided to make a life transition, moved to Greenville, South Carolina, 2,800 miles away. Didn't know anybody, but kind of loved the town. And 10 years later, we're fully in love. This is the Liberty Bridge, which is downtown. There's a river that runs through it, waterfall. It's kind of a cool place.
Nice.
But to get to your question, I had a call from a friend, young investor guy, right when COVID broke out. So this would have been March of 2020.
Yeah.
And that's about the time we started to really know COVID something. We had heard about it. And he talked to me about, well, how do you think it's going to impact rent collections? I said, Mario, I don't know. talk to me April 5th. Let me see if I get my April rent in. And at the end of the call, he turned me on to a podcast about multifamily real estate. And that was really kind of the genesis. And I made the transition for a variety of factors. One, I'd done the single family for 4 decades, kind of wanted to learn something new. I think as long as you're learning, you're still kind of growing, you have some excitement. So that was part of it. But one of the major reasons was with multifamily, it typically is kind of a team aspect where generally you form teams of 2 or 3 people, 4 people, and they kind of handle the totality of the deal. And what the team aspect allows you to do is focus on your specific strengths, focus on what you especially enjoy, and then you find partners and teammates who fill in the puzzle and take care of the stuff that you aren't as good at or that you don't enjoy. And so for me, I love hunting deals. I love talking about real estate. I love talking to investors, but the operational aspects, the day to day, I don't know.
Tenants and toilets, is that what I'm hearing?
Yes, and termites, let's call it drudgery. That doesn't really rock my boat.
Yeah.
But over time in Greenville, I turned over my single family rentals to a property manager, Brian Walsh, and we developed a relationship. And I actually kind of courted him for about a year or two to come to multifamily. He was a single family guy with me. And once he came on board, and I knew I had the partner to run the assets, then it was full speed ahead because as a syndicator, you're asking people to entrust you with their hard-earned capital. People work hard to develop capital to invest. And so for me, I could only do that if I knew I had the partner and teammate who could actually handle the assets that I found. And we did our first deal, closed in May of 2021. And now in syndication, I'm up to over 1,000 units. So it's just been a great fit. And I didn't jump from residential to office. I didn't jump from residential to retail. I jumped from single family to multifamily, but it's still residential. And so I have a wealth of experience and knowledge and expertise that the transition between the two asset classes was relatively easy.
Wow. Okay. Let me unpack a little bit of that
I
there.
know. Sorry, I went on and on, but
No,
anyway,
no,
I'm
that was good.
passionate about it.
So I'm going to rewind a little bit. 4 decades in the real. So you took over your dad's real estate company, became the broker, did that. It kind of stepped into your father's footsteps as well with the investment strategy, focusing on single family homes first in San Francisco. And then you started to spread out there. So maybe before you moved or before you switched over to multifamily, do you mind sharing what kind of a single family home portfolio you built up?
Yeah, I would say at one point I probably built up to maybe 25 to 30 single family homes. And just to clarify, within the single family designation, there were a few duplexes and fourplexes fit in. So, but it was single family 2 to 4 unit. And I got to about 30. And the ones that were local to me, I kind of self-managed. The ones in Austin, where I did a lot of investing, there I had local property managers. So that's how it kind of developed. And of course, when you own 30 properties, you got to pay 30 mortgages.
Got 30 roofs to deal with.
You got 30 roofs, you got 30 hot water heaters. And And yes, your property managers take care of a lot of the expenses, but at the end of the day, you're kind of doing the accounting. You've got insurance premiums. Typically, with the property management contracts, uh, if the repair's over 250, maybe $500, the property manager has to get a hold of you. So there still is an involvement there, and it's quite a bit to handle. And then, of course, if you know about the residential brokerage business, and if you can imagine in Silicon Valley, it's pretty competitive. Big prices, big commissions, it's competitive. That's a full-time job
Yeah.
plus 50%. And so then you add the real estate on. And so that's how it kind of was. And what my dad kind of said was, hey, the brokerage will create the income, but what you really need to do is turn that income into capital that you then invest. And that's really what creates long-term wealth and financial security. And coming from Silicon Valley, of course, we have a lot of people in tech
Yeah.
who make big incomes, have a lot of capital. And so one of the things I do now is help them kind of diversify into real estate, because most of them are heavy into company stock and the
Yeah.
stock market. So I help them diversify, and I'm a big
Stabilize a
believer
little
in
bit there.
yes, and
Yeah.
and I think it's kind of a crazy financial world when you really look at it.
Mhm.
And so I think one way to minimize risk is through diversification. And I think at a point where you accumulate a certain net worth, capital preservation then starts coming up the priority list. And I think real estate's a good way to do that. It's a tangible
Boring
asset.
becomes sexy, I've heard.
I use that expression myself. Boring can be sexy, and the way I invest in real estate is kind of boring too. I go to hit line drive base hits.
Yeah.
I don't swing for the grand slam. You know, make me 15% a year on my capital. I'm happy. It's good enough for Warren Buffett. It's good enough for me. I'm small potatoes, but that's how I built my life, and it's worked out for me.
So you said it was about 10 years ago, if I'm not mistaken, that you moved from California to South Carolina. Did you sell off your brokerage at that time, or you still have
Uh,
involvement
no,
in it?
I cut ties there. I sold all my property and kind of made a clean
Sure.
break. Some of it I 1031'd out into Greenville. Uh, Sold my personal residence there, and even with the capital gains extension, I wrote the biggest check ever in my life. But as I tell people, we pay taxes on every dollar we make. And the truth is, real estate investment is typically about one of the most tax advantaged investments. So I made the decision to take my profit on my home that I had owned for 28 years, uh, pay the taxes, and now I've got cash. There's no ties to it, and I'm ready
Yeah.
to rock and
Yeah,
roll. So that's the
it's a
decision
clean
I
break.
made.
Yeah,
Correct.
that makes a lot of sense. Arn, the other thing that really kind of stuck out for me was the team sport aspect of it, because it sounds like you were a lone ranger with a single family home. Yeah, yeah, a little bit of help here and there with long distance management and stuff like that. But now you've created a team around multifamily investing. We talked about yourself being the deal finder, the capital raiser kind of guy. Your partner's more on the operational side of things. Maybe walk us through that first deal, because it wasn't that long ago, 2021, that first multifamily property. What was it? Where was it? How'd you find it? What was, in a snapshot, what was the biggest learning that you took away from that experience?
Yeah, so yep, you always remember your first, right, Dave? So applies to a lot of
A lot of
aspects
things.
of one's life. So it was 43 units in Greenville, South Carolina, and basically I had started to develop a relationship with a broker here in Greenville, maybe about 18 months prior. And he brought me a few deals, and either they weren't quite right or I wasn't quite ready. And then this one popped up, and I kind of got first crack at it. And this was after a period of kind of educating Brian about multifamily, and he was getting closer. And so we took a look at it and we both liked it. And we then went into contract very quickly. We basically got the property off market basically because of this personal relationship which I built with this local broker here in Greenville. And not a huge deal, 2.8 million, 43 units. Uh, but it was my first syndication deal.
Mm.
And we needed to raise about 1.5 million. We thought we could raise 1.5 million, but you don't know until you actually do it. Um, the brokerage shop that I acquired the property from also had a debt component. So we worked with them to arrange the debt, got Freddie Mac small balance debt. And uh, I borrowed a lot of money in my life, but it's all been single family, 2 to 4 units, which as you know, is a whole different world than
Yeah.
when you go to 5 plus. And when you go to agency debt, kind of the level of documentation, the level of scrutiny, the experience requirements. So that was probably my biggest learning curve, was figuring out how to do the agency debt. And at that point, I was in a mentoring program with a person who's now been has become a good friend with me. And so I was right smack dab in the middle of the mentoring program when this opportunity came up. And, there's always a few emotional ups and downs when you're acquiring property. Am I doing the right thing? Does this make sense? Et cetera, et cetera. So he helped me through that. The other part is with agency debt, you actually have to have multifamily experience to get agency debt, which then, of course, raises the question, well, how do you get an agency loan if you need agency debt loan
Yeah. Catch 22,
experience,
right?
right? It
Yeah.
is. So the answer is you bring in a partner. In this case, it was my mentor, Reed, who did have experience with agency debt. And he co-signed on the loan with us. And in return, we gave him part of the deal. And it was the best money I've ever spent. So we still own that property to the day. It's one of our favorites. We bought it at a good time because if you recollect back, so May of 2021, we're maybe about a year into COVID. Uh, the massive money printing kind of was just getting ramped up. The federal programs to help
Yeah.
things, and it basically set off inflation, which was definitely reflected in rent. So we ended up getting 3.86% debt fixed
Wow.
for 7 years. We got another 4 years to go, 4.5, if I could do the math right. And we benefited from kind of inflation and rent increases. So that deal's doing great. And that was the first one. And we ended up raising the 1.5 million, primarily from my past real estate relationships, And then my partner, Brian, he manages about 500 single family homes here in Greenville. And so he had a database of people who knew Brian knew what he was doing. And so then when Brian says, "Hey, we've got this deal, do you want to invest?" His people are naturally inclined because they have a track record with
Yeah, they
Brian.
already knew
Just
him, liked him, and trusted him. Yeah,
yeah, yeah. So that was the start, and from there we were off and running.
so since then, you've added on another 1,000 units to your portfolio. Um, have you been co-GP on most of those deals, or boots on the ground guy, or what's your
Uh,
role in these other syndications that you're part of?
yeah. So another great question. So um, as lead GP, as lead sponsor, uh, we probably have about 400 units in Greenville. And all those, we got fixed rate debt. They're all humming along. Everything's okay. Uh, then the largest deal we bought in Greenville was 281 units. And that one, my mentor, Reed, out of Los Angeles, is actually the lead sponsor. We're kind of boots on the ground. And then the other 500 or 600 units, which are primarily in the Southeast, I'm more a co-GP and I raise capital, so I don't have operational control. And I would say one of my growth points is, so if you rewind, lots of real estate experience, but I was kind of the new kid on the block with multifamily.
Yeah,
And so I kind of started as a co-GP and I deferred to some of these operators. Uh, and then what I came to understand is they don't know any more than I do. And in some cases, they know less.
and they got
Uh,
less life experience. Yeah,
less life experience and less investing experience. I mean, one of the interesting things about syndication is it basically became widespread in 2012.
Mhm.
I think there was a Jobs Act that somehow opened syndication to kind of average Joe and Jane's. Uh, so from 2012 to 2022 into 2023, we basically had a bull market in real estate. So most syndicators had never experienced a down market until 2023. And now we're seeing some people get exposed because the market was so frothy in multifamily 2019, 2020. You
yeah,
could buy anything and you didn't need to know what you were doing. Cap rates plummeted, interest rates plummeted, values went up. And so this last year or so has been the first time Murphy's Law or reality has hit. And I would say for me, I paid 11.75% for my first house.
wow.
I actually sold houses when rates were 16 and a half, 17% adjustable. And so I understood historically low rates didn't mean normal. Right. And I think a lot of people lost that. They just kind of
It was going to
decided,
last forever. Yeah,
yeah, 3%. What the heck?
that's normal.
So,
Yeah,
yeah. So, anyway, that's kind of how we do it. Yeah.
yeah. Arn, well, we could chat for a long time. You got lots of experience, my friend, but time flies. And if people want to find out more about you and maybe connect with you, where should they go? What would you recommend that they do?
Yeah, so I'm very active on social media, either under my name, Arn Cenedella, or my company, Spark Investment Group. Website is investwithspark.com. So pretty easy to find and happy to help folks in any way I can.
Awesome. Well, hey, Sounds like you're doing great things and you're having a lot of fun and you're doing what you like to do. So keep up the good work.
That's the key. I'm going to keep doing it as long as I have fun. I can ride off into the sunset anytime I want, but helping people and having fun, what could be better?
Exactly. All right, my friend. Good to meet you. And everybody, thanks for tuning in.
Thank you.
Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewyou.com. Now at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.